This is Bloomberg Daybreak Middle East and Africa. The Bank of Japan has hiked for the first time since 2007 and scrapped its yield curve control. The yen's weakening to a two-week low, attention now turning to the central bank's massive ETF holdings. It's just gone 8 a.m. across the Emirates. I'm Lizzie Burden in Dubai. Good morning. It is the end of an era. The Bank of Japan has ended negative interest rates 17 years since the last hike. And we have one here today. Let's get over to Avril Hong in Singapore for the market reaction. Avril.
Yeah, Lizzie, end of an era, but also one that was pretty well telegraphed given the media reports surrounding this in the lead up to this event. We have markets reacting as expected to the scrapping of yield curve control, the scrapping of ETF buying, and of course, that rate hike. And the read-through seems to be that beyond this, the BOJ is one and done. So in a way, it seems like a dovish hike coming from the Japanese central bank. And for equities, they've been fluctuating, but more or less pairing the declines from earlier in the session. The Nikkei slumped as much as 0.5% thereabouts earlier. The topic's actually clocking some gains now. The laggard today, those Japanese lenders that are expected to benefit from normalization of policy, they declined as much as 2%. And we're also seeing the yields pick up. But of course, it's really about that yield gap. And we're seeing the yen continued weakness towards almost that 150 level. Let's flip the board, because if you thought the BOJ was dovish, the RBA also came in pretty dovish. And we saw the Aussie earlier giving up some of the gains against the yen after it didn't make any reference to the need for further rate hikes. Of course, we'll be watching how this plays out the rest of the session as we watch for Michelle Bullock's presser later today. Lizzie.
All right, Avril Hong in Singapore, we thank you for staying across the market reaction to the BOJ and RBA decisions. And now we can dig deeper into the BOJ's decision. We've got Stephen Engel outside the Bank of Japan on standby for us. He is our chief North Asia correspondent. Stephen, they'd waited 17 years. Why couldn't they just wait a little longer for that April economic report to hike rates?
Well, I guess they had the data they needed. You're absolutely right. Most people, when I was here on January 23rd, when they decided to hold, everyone pointed to April would be the most logical time. By that time, of course, the spring wage negotiations would have been fully completed and also digested. And also you would have gotten that quarterly economic report that comes out next month. And that just seemed like the right time. However, those wage negotiations ended up with much higher wage gains for corporate Japan than most expected. In the first round on the Rengo on Friday, essentially put wage gains of 5.28%, much higher than the previous year of 3.8% and much higher than the consensus estimate of around 4.1%. So obviously, Governor Ueda and the other 8 members on the board of the Bank of Japan felt they had the data, that this is a virtuous cycle of inflation backed by wage gains. That being said, one of the key lines in the statement is that they will maintain an accommodative policy stance, and no indication of there's going to be necessarily further tightening. At least they're not telegraphing that right now. So perhaps it's one and done. We'll have to see going forward.
And how will history judge negative interest rate policy, do you think?
I think a very mixed picture, obviously. It was unprecedented and unorthodox in many ways, including with the yield curve control, which they now have decided to scrap. And yet at the same time, they're also telegraphing that they're going to basically keep up the same pace of JGB bond purchases going forward. Obviously, they can tweak that in subsequent meetings. But again, we've had policy missteps in the past. We've seen the Bank of Japan essentially withdraw stimulus prematurely in the past and then be absolutely eviscerated politically for that. So this time, with the exit of negative interest rates, it's a very I wouldn't say very dovish, but a fairly dovish statement and obviously stance from Governor Ueda. He does not want to make the same past mistakes, but at the same time essentially declare that Japan is now out of negative interest rates.
Stephen Engel, fantastic to get your reporting from outside the Bank of Japan. We thank you, as always. And for more, let's bring in our FX and rate strategist, David Finnerty, for more on the market reaction. David, it looks like the fate of the yen is more in the hands of the Fed.
Yes, definitely at the moment. I mean, what happened today was well choreographed, and so the market's not surprised by it. And again, the key thing is always going into it was if they're going to raise rates, how many more rate hikes do they signal, if any, this year? As Stephen's already pointed out, at the moment, they really haven't signalled any. Now, I'm sure Governor Wade will be pressed on that in the actual press conference, but if he kicks that can down the road till the April meeting, the market will only go with what it knows, which is, OK, at the moment, you're saying no rate hikes. That's not yen positive. Over to the Fed dot plot. If that comes out slightly more hawkish tomorrow, we'll say 2 rate cuts compared to the median 3, then that'll be dollar supportive as well. So that would see dollar yen, you think, certainly push above the 150 level. It could certainly test the recent high of around 150.89.
And as you say, this is what markets were reacting. What sort of reaction are we seeing in stocks?
At the moment, it's sort of a muted reaction. Again, nothing was really surprised by this. I think going forward, one of the key things, certainly for stocks, will be actually, ironically, how does the US stocks react to the Fed dot plot tomorrow? Do they keep this grind higher, which will keep that risk-on sentiment going globally? If they react negatively to it, what tends to happen is where US equities go, other equities tend to follow. So even in Japan, you may see a correction if your equities don't like what they see in that Fed dot plot tomorrow. So the US really is in control of a lot of things moving forward, one could argue.
All right, David Finnerty, we thank you for that analysis. We'll come back to you later. But I want to now bring in Katrina Ell. She is Director of Economic Research at Moody's Analytics in Sydney, because, of course, we also need to talk about the RBA decision. So, Katrina, let's start there. Your reaction to the RBA holding today?
Yeah, it was not that interesting a move compared to what's happening with Bank of Japan, to be honest. No surprises that the RBA decided to keep the policy rate on hold. But I think it was really interesting, the 2 points that they highlighted, first being inflation is still, too high. It needs to come down further, because I think what we're seeing in Australia is a lot of momentum build towards how quickly these rate cuts are actually going to come to be. And so I think what the RBA is trying to do is really throw caution to the wind and say, look, we need to really bring inflation sustainably back to this 2 to 3% target range. It's not there yet. One of the reasons why it's not there yet is because services inflation is proving incredibly sticky, and so we need to wait for that to come down before we really consider before we consider when rate cuts are actually going to come to be. And I think, that's not really an Australia-specific problem when it comes to sticky services inflation. That's a problem that we're seeing throughout the globe.
So you don't think that the last mile of inflation is harder to walk specifically in Australia? Because you've got a handful of analysts saying that there may be no cuts this year. Do you share that view?
So we're actually a little bit more hopeful than many. We're expecting that we will actually see the first cut in September. We do think that while the RBA is being incredibly conservative and cautious, as they should be, when we are expecting the first cut to come in September, because I think, the RBA is, understandably being very cautious in their guidance when it comes to what the next move will be and the timing of that, because they want to make sure that inflation is where it needs to be. And I think the good thing is that the economy is actually holding up really well, given how much tightening has been delivered. So there's no need to rush when it comes to that cut.
I'd also love to get your reaction, Katrina, to the BOJ decision and your expectations for the Japanese CPI number on Thursday.
Yeah, so it's very exciting coming out of Japan. I mean, it was, I think the Bank of Japan was looking for a good reason to exit negative interest rates, and they got that with the strong preliminary Shunto figures. And so given that, they've taken that momentum and run with it. I mean, our expectation is that we probably won't see too much more when it comes to the policy maneuvers, because I think the backdrop in Japan just doesn't support a more aggressive, exit out of the ultra accommodative monetary policy stance that they do have. I mean, if we're looking at the underlying backdrop, consumption is still, quite soft. Private investment is weak too. Exports are not going anywhere quickly. And so I think it was interesting that the Bank of Japan actually highlighted that this new policy stance that they do have does remain accommodative to continue to provide some support to domestic demand. But when it comes to the CPI figures for February that will be released, we are expecting it to tick up to 2.7%. But I think that's largely based on temporary factors, including fading government support and also the weak yen, of course, driving that increased imported inflation.
Just while we're on our world tour of central banks, let's talk the Bank of England. Do you think that the meeting on Thursday could be the one where finally the hawks vote to hold?
I think that's what we will see. So our expectation is that we won't see any movement out of Bank of England. I think that it looks like they have done enough, but at the same time, you don't want to be calling that too soon, because what we're seeing is that inflation is proving sticky and they don't want to be stopping too soon, just as other central banks don't want to be cutting too soon, just to make sure that inflation does sustainably return to where it needs to be. And, in England, it has proved incredibly sticky. So they will be cautious on that front. But our expectation is that they will be a hold.
And just closer to where you are, away from central banks, do you expect New Zealand to slip back into technical recession?
So our expectation is that they will just narrowly avoid recession. I think, New Zealand households in particular are really struggling at the moment in this high interest rate environment. And so our expectation is that they will just narrowly avoid that recession. There is some strength in exports that's providing that support. But unlike Australia, they don't have that same sort of population growth that's propping up the aggregate picture in New Zealand. And so they are kind of, traveling at a slower pace in this high interest rate environment. So we'll avoid technical recession, but very modest, underperforming growth for New Zealand throughout this year.
And what about your outlook for China? What sort of support does the Chinese economy need to hit that 5% target?
I think that's really the million-dollar question at this point. I mean, our expectation and our growth picture coming out of the two sessions was that we actually responded by downwardly revising our GDP figure from 5% to 4.7%, because we're just not seeing the level and, coverage of stimulus that we would expect to see and need to see for the government to actually reach that 5% target. I mean, if we're looking at the household picture, it's incredibly weak. Consumer confidence is underperforming there. We're seeing private investment as well. It hasn't returned with any sort of gusto that you'd expect, given that they don't have COVID restrictions anymore. And what we're seeing is that the government is really focused its efforts on industry and exports. And so providing that support to domestic demand is really lacking. And that's, of course, against the backdrop of this correcting property market, which is, of course, having its negative tentacles and negative impact throughout the economy. So unless we see more targeted support to, private businesses and households, I think we're not going to reach that 5% growth target, unfortunately.
OK, Katrina Ell, Director of Economic Research at Moody's Analytics. We thank you for that analysis of the various central banking decisions we get this week. A reminder, the Bank of Japan has hiked rates for the first time in 17 years. We'll continue with our analysis of that as we look at the dollar-yen at 149. Plenty more still ahead. This is Bloomberg Daybreak Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. We have had an end to an era. The Bank of Japan hiking rates for the first time in 17 years. It was well telegraphed, but here's the market reaction. You've got a boost to the Nikkei 225, higher nearly 0.1%. The Topix higher 0.6%. And there's the yen at 149. We've also got futures in the US session pointing to a lower opening. Nasdaq futures down 0.2%. You did have a positive end to yesterday's session driven by tech. We had that Bloomberg scoop that Apple's in talks to build Google's Gemini AI engine into the iPhone. That boosted Alphabet. And you had Nvidia announcing its new chip launch, but hard to impress investors when it's already up 79% this year. It turned out to be more of a sell the news event. The shares actually slipping in post-market. That weighed on semiconductor Asian stocks this morning. And you've got the MSCI Asia Pacific Index currently lower at 0.3%. But we can dig it now more into the Nvidia story. Nvidia, as I say, unveiling new chips aimed at extending the world's third most valuable company's dominance of artificial intelligence computing. The CEO, Jensen Huang, showed off the new processor design. It's called Blackwell at the company's GTC conference in California.
This is Hopper. Hopper changed the world. This is Blackwell.
Let's bring in Bloomberg's Edwin Chan in Hong Kong. Edwin, it didn't really move the needle for the stock, but just talk us through the options activity yesterday.
I think let's talk about moving the needle for a second. I mean, they became the world's third largest company based on Hopper, essentially, in the way that they have managed to dominate the entire AI hardware space. I think Hopper is a tough act to follow. Jensen did his best overnight to talk about how Blackwell will again propel Nvidia's lead forward, which is something I think that remains to be seen. I think Nvidia has a good track record, and I think right now, in terms of supplying the AI boom, it's the hardware players that are benefiting most immediately and most evidently. I think you just talked about the market's reaction. The stock went down a little bit, but I think you're alluding to the fact that a lot of people are betting the options market on further upside for Nvidia, which is quite remarkable. I've been covering this sector for years, and I've not seen the amount of excitement, shall we say, around a chip maker, not for many years at least.
And this speech from the CEO kicks off the GTC event in California, the Woodstock of AI. I wonder what else is on the bill, what else he had to say.
It seemed like everybody was at Woodstock, as you said. He name-dropped a whole bunch of chip makers and partners, companies on three continents, I think, are right now kind of scrambling to put out press releases on how they're working with NVIDIA or how NVIDIA is working with them or how they want to work with NVIDIA. I think, the excitement persists. It'd be interesting to see how Blackwell performs in the wild. NVIDIA is touting this as several-fold more powerful than its Hopper lineup, which, if true, is, again, quite remarkable. But we're all eyes and all ears.
And Edwin, just briefly, just talk to us about what the difference is between Blackwell and Hopper for anyone who's not really an AI nerd here.
It packs a lot more transistors into a larger space, for one thing. I think you just showed that clip of Jensen holding up the two chips side by side. You can tell it's noticeably bigger. Experts say Blackwell is essentially two chips tacked into one with, shall we say, a seamless connection between the two so that it functions as a single entity. Beyond that, I'm no chip expert, but again, NVIDIA is touting performance several orders above the old generation. It'll be quite exciting to see it in action.
All right, exciting stuff. Bloomberg's Edwin Chan, we thank you for explaining that for us. And I want to stay on this because a little-known Indian upstart is making a big bet on AI with Nvidia's support. Edwin told us Jensen Huang was sprinkling the stardust. Yotta is aiming to offer high-performance computing capabilities from data centres in India so that the country will be able to develop its own AI services. Its co-founder and CEO is also promising customers the world's cheapest access to Nvidia AI chips. Take a listen.
For the potential of India to serve its own AI requirements, India needs much more than 16,000 chips which we have ordered. And India, like it has been a destination for IT outsourcing for the world for so many years. I'm very sure India will also become the AI garage of the world. So India for India and India for the world need these chips. This is just the starting point. We have miles to go.
And just a check of the markets before we leave you for a moment. You've got S&P E-minis and Nasdaq futures pointing to a lower opening after a higher end yesterday. European Stocks 50 futures also pointing to a lower opening, lower 0.2%. A quick look to Treasuries. The 2-year Treasury yield lower 2 basis points at 4.71%, so still hovering near 2024 highs. This as Fed cut bets erode further. And we're going to discuss all of this and more next. Stay with us for that. This is Bloomberg Daybreak Middle East and Africa. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. The Bank of Japan hikes for the first time since 2007 and scraps its yield curve control. The yen weakening to a 2-week low. Attention now turning to the central bank's massive ETF holdings. Nvidia unveils a new AI processor at its company event, but the highly anticipated announcement proves to be a tough sell with investors as shares slide post-market. And Israel and Hamas reportedly head back to the negotiating table for the first time in months, as President Biden warns Benjamin Netanyahu that a major Israeli ground operation in Rafah would be a mistake. Well, good morning. It has just gone 8:30 a.m. across the Emirates. I'm Lizzie Burden in Dubai, and it is the end of an era. The last negative interest rate regime has ended. The Bank of Japan hiking rates for the first time in 17 years. It's also scrapped yield curve control and ETF purchases, and we're going to bring you analysis of the decision and the market reaction throughout the programme. But let's get you up to speed on these markets. You've got a risk-off session here. The MSCI Asia Pacific Index lower 0.4%. Stocks in the US pointing to a higher opening in terms of futures as they are in Europe. And if we flip over to the cross-asset picture, you've got Treasuries pretty steady. The yield on the 2-year hovering near 2024 highs, currently 4.71%. This is as we look tomorrow to the Fed decision. Fed cut bets eroding further. Attention on the dot plot. Goldman economists have changed their call from 4 to 3 cuts this year. Dollar steady, Brent at $86 a barrel. But it's not all about the BOJ today. We've also had the RBA holding rates as expected. And now we can go over to Michelle Bullock, the RBA governor, who is making her commentary on that decision.
As I said before, we want to hold on to as many gains in the labour market as we can. What we need is greater confidence that inflation will return to the target band in a reasonable time frame and will stay there. So domestic data over recent weeks have been largely as expected. The board believes the risks to the outlook are finely balanced and that it's too soon to rule anything in or out. The data showed a slowing in GDP growth in the December quarter, slightly higher unemployment rate, slightly higher wages growth and a further moderation in inflation. We understand that households are still bearing the brunt of this inflation challenge. We see that in the weak consumption data, and we know that there is a big cost of living squeeze on households. Unemployment's also ticked up a bit. Employment's continuing to grow, But these are firmly on the board's radar, and that's why we're being cautious. Wages growth picked up a little further, and it's expected to moderate, but it may take some time. There's been little new information on services inflation, which is where the recent pressures have been. This strength has been because demand continues to exceed supply in the economy. So although there's signs this gap is closing and we're moving towards a better balance in the economy, things remain uncertain. And the other thing I would add here is that we've seen overseas that it can be a bumpy ride on inflation. So today, as I said, the board decided to hold rates at current levels. To the future, we still have to get inflation down, and the risks to achieving that remain finely balanced. The war isn't yet won. So we continue to be vigilant, and we can't rule anything in or out. And with that, I'm happy to take your questions. Thank you.
Hi, Governor Edward Boyd at Sky News. There's a subtle change of language in the statement today. The phrase "a further increase in interest rates cannot be ruled out" has been replaced by the phrase "the board is not ruling anything in or out." Has your hiking bias...
So a cautious note from Michelle Bullock there, the RBA governor, after the RBA held rates at a 12-year high, 4.35%. It was what was expected. So let's get some more analysis of what is interesting here. We've got Bloomberg's Australia economist, James McIntyre, with us. James, thanks for joining me. I wonder about the path ahead. You've got various economists warning that the RBA is not going to cut rates this year, that the last mile of inflation is harder to walk for Australia. Do you agree with that view?
Thanks, Lizzie. Look, not necessarily, no. We don't agree with that view. We think that inflation is probably going to continue to disappoint, undershoot the RBA's projections, and that's especially as the demand side of the economy weakens by a lot more than the RBA might be expecting, and the supply side responds. So we did have some other news today that is more of a draft form on the inflation front, but it's really helpful for some of those lingering inflation pressures within the economy that the RBA has been worried about, and that is electricity prices. They're proposed to fall by up to 10% next year after a couple of years of very strong rises and being part of the inflation problem. So this sort of whipsawing is one that's more regulatory, but as we see the demand side of the economy coming through and being a lot softer, those struggling consumers that Governor Bullock just mentioned then, and earlier in the week we saw in a panel discussion the new chief economist of the RBA, Sarah Hunter, also mentioning how consumers were very much struggling. Once that feeds through to the demand to businesses, then their ability to pass through some of those cost pressures becomes quite challenged in our view, and could see inflation recede a little bit faster, leaving the RBA much better positioned, and also perhaps a little bit vulnerable from a growth perspective in policy over the next couple of months. We see that shift coming more towards the middle of the year.
OK, and you've had a chance to rifle through the documents, the commentary that comes around this decision. I haven't, so you can tell me what's in there and what you made of Bullock's tone in the bit of commentary we heard there.
Yeah, look, very much in the commentary at the stand-up in the press conference there, trying to kind of make the point that that the central bank is not thinking that this fight is over, but really we are in the dying days of the inflation battle. And I guess the change in the statement that we identified, and just before we faded there, the first question was picking up on, is in the change in the forward guidance. Now, the RBA, a lot more incremental today than, say, the BOJ, but what that incremental change showed from the RBA was them moving away from their previous statement that a hike can't be ruled out, and very much more talking about the need to continue to restrain demand and being worried about inflation. To this month, or this meeting, we've now got the RBA noting that there was a lot more moderation and a lot more progress on inflation, and now beginning to identify and discuss two-sided risks with interest rates, that nothing can be ruled in or can be ruled out. That with an extra addition to the statement where they note that the the board's decision-making will be guided by data and evolving risks, suggests to us that that softness in the demand side of the economy, the weaker GDP data and those struggling consumers that were noted in the statement and also in Governor Bullock's comments just before, those are something now something that's a lot more prominent on the table around the boardroom, and something that we think is now leaning the RBA board incrementally as the months go by and as we go into the middle of the year, leading them more towards not only moving to neutral but beginning to cut and support demand again.
OK, really helpful context. Bloomberg's Australia economist James McIntyre, thanks for joining me with that. And I want to dig deeper into the market reaction to that RBA decision and check on how markets elsewhere in Asia are faring. Avril Hong's waiting for us in the Singapore studio. Avril.
Yeah, we're seeing the Aussie reacting against the backdrop of the RBA decision, but also the presser from Michelle Bullock. And if you remember her last briefing, that not ruling anything in or out, that phrase being repeated seems to be taken by the market as not much of a hawkish surprise, so perhaps that relief in that and a bit more of a less hawkish stance. Remember, it removed the phrase of the need for further rate hikes, so that seems to be the read-through, and we're seeing the Aussie dollar losing ground against the greenback. Flip the board, because indeed, if you take a look at how it's faring against the other pairs, it's also losing ground against the Kiwi, and we are seeing an Aussie dollar that potentially could come under continued pressure because of the weakness in the Chinese economy, because of the slump in iron ore prices. It is gaining ground against the yen, though, but that's got to do with what we're seeing from the BOJ today. Flip the board. We are hearing how the central bank has done things pretty much as the markets anticipated, scrapping yield curve control, ETF buying, raising rates, but perhaps some relief coming through for bond markets as the BOJ says that it will more or less keep up with the kind of amounts of JGB purchases. So we're seeing that reaction in JGB futures as well, Lizzie.
Thanks, Avril Hong, for that update on the markets, their reaction to the BOJ. And we can get analysis now with Fard Iqbal. He's CIO Middle East at UBS Wealth Management. Fard, great to have you in the studio with me. On the BOJ decision, for anyone who's looking to get in on the Japanese stock market rally, how concerned are you that higher rates now are going to curb growth?
Well, we're not very concerned because we have seen a modest increase. It is the first increase, as you guys said, in 17 years. But the financial conditions within Japan are still very, very easy. It is still a 0% rate. And quite frankly, there are other factors driving the more positive longer-term outlook for Japanese equities. You are seeing inflation coming through for the first time on a sustainable basis. The wage increases that we've seen being negotiated through recently, that's going to be supportive towards consumer spending. And there's a lot of corporate governance reform underway that we think will actually unlock a tremendous amount of value from Japanese equities, despite the fact that we've seen, a very sizable rally over the course of last year and year to date. On a long-term view, there's still a good upside ahead, we think.
OK, and perhaps more importantly for the yen, since the BOJ decision was so well telegraphed, so fully priced in, will be the Fed's dot plot tomorrow. We had a raft of US economic data last week. Did it move the dial for you in terms of how many cuts the Fed will make this year?
So our view is unchanged. We still see 75 bips of cuts for the year as a whole, starting in June. But we are seeing increasingly the risk move towards, lesser cuts over the course of the year. I mean, our view still remains the same, but the bias is slightly moving now. And even with the dot plots in the meeting that we're having this week, there is a possibility that you see the dot plots showing 50 bips of cuts for this year. Mathematically, we think it'll only take two FOMC members to change their view anyway. So it's not really a massive change in that respect. But from our perspective, we're still looking at 75 bips.
OK. And of course, the Fed's cuts this year are going to have huge knock-on effects for where we are, the GCC. I wonder if I could ask your outlook on this region, especially for Dubai real estate.
So for this region, the backdrop of having the US economy still being robust and avoiding a hard landing, which was really the big concern coming in end of last year, that provides an excellent economic backdrop for this region. I mean, Dubai especially, it is a very cyclical economy. And yes, there are very strong domestic drivers, But if you were to see, for example, a recession in the US, it would absolutely have a knock-on effect onto this region.
You don't see that?
We don't see that happening. We don't see that happening. We still see the robust outlook continuing. In terms of interest rates coming down gradually in the US, yes, that will definitely ease the backdrop for mortgage-based buyers in Dubai real estate. I don't think it'll be enough to fuel a further increase on its own, but it certainly will help draw a line of support under further reductions or how far real estate prices can correct in the near term, simply by providing a new base of demand to come in as mortgages become cheaper. Our view on Dubai real estate has been quite cautious for some time. It is an expensive, increasingly expensive real estate market. The momentum has been very strong. That can't last forever. Our concerns are still very much there, but in terms of timing, we think near term, the scale of correction that you can see in Dubai real estate is probably a lot less now than it was before, just courtesy of the US economy holding up well and interest rate cuts coming. But the scope for a larger correction, I think, is still there. It's just been pushed back a few years.
And if we could just jump to Egypt, because I know it's something you feel passionately about, given the risks around it, is the carry worth it?
It is a high-risk trade, absolutely no doubt. We have a positive view on the outlook for the carry trade, but it does carry that caveat that this is really only for investors who have that high level of risk appetite. We think on balance you are going to see EGP remain within that 45 to 50 range that we've been talking about for some time and head more towards the lower end of that range. We think it'll be difficult for EGP to really sustain a move above 50 on a longer term basis. We think the central bank and the government are going to be keen to avoid it. And with the strong inflows that we've seen coming into Egypt, courtesy of the UAE, potentially more to come in any future deals, that should limit that risk as well.
But how long do you think investors are going to need to give time to the FX stabilisation, feel confident to actually start buying Egypt's debt?
For us, the Egypt trade is really, goes on about as long as 12 months. It's not something which we would be looking at on a longer term view. The environment for Egypt is much different to what it was back in 2018 or 2017 when we last highlighted this trade. At that time, Egypt had the highest real rates in the world and against a background of zero interest rates. Today, it's the exact opposite. We've got high interest rates and Egypt has negative real interest rates. The economic backdrop in Egypt is very weak, and it has been for some time, and government credibility is pretty poor. So I think these are all factors investors need to keep in mind. It is not a very long-term trade, but we do think in this horizon that we're looking at, the 6 to 12 months, it certainly has value.
OK, really interesting to get your thoughts on this region, despite all the many exciting things that are happening elsewhere in the world, the BOJ, the RBA, and the Fed, of course, tomorrow. Fard Iqbal, CIO for Middle East at UBS Wealth Management. Great to have you with me.
Thanks.
We've got plenty more still ahead. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. Now, the worst may not yet be over for Ghana's cedi, Africa's third worst performing currency this year. It's already lost more than 7% against the dollar. Let's find out why and bring in Bloomberg's Ondiro Aganga in Kigali. Ondiro, what factors are going to drive the anticipated depreciation this year?
One of them could be weak reserves, Lizzie. And although they hit a 10-month high in December of $5.9 billion, economists say this is nothing compared to the reserves they had in 2022. And hence, they're very thin and unable to buffer the cedi. And we're also seeing that the central bank has spoken, and they're saying that one of the policy priorities of the IMF is to ensure that the central bank builds up its reserves. So the central bank is saying they're not going to intervene and almost resuscitate the cedi. They'll allow the the market forces to do their thing. Important to remember that in December, Ghana is heading towards a general election, and that comes with a lot of FX demand. Outside of that, economists are saying that Ghana defaulting might have been catastrophic, but it threw the CD a lifeline. So far, Ghana has been able to restructure $5.4 billion of its domestic debt, but still working with $13 billion Eurobond holders to work out a deal, and the holders want a sweetener.
OK, so that political risk on the radar of foreign investors. What does the depreciation mean for the economy?
It just poses a great risk to inflation. Remember, Ghana is a very import-heavy country. They import a lot of things from basic foodstuff to non-foodstuff to things like toothpicks. And so this is going to pose a great risk to inflation. The government has done a lot of work in bringing inflation down to about 23.2% in February. But let's not forget that the lingering ghost of high inflation in December of 2022, where it hit an all-time high of about 54%, still is in the horizon. So that is one of the risks. And also, if the currency continues to depreciate, it could increase the debt servicing cost for a government that is already cash-strapped.
OK, Bloomberg's Ondiro Oganga in Kigali. We thank you for that update on the CD. We'll have plenty more ahead for you, so stay with us. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Verdon in Dubai. Now, Israel and Hamas are reportedly negotiating for the first time in months on details of a possible deal to release hostages during a temporary ceasefire. This is according to Axios, who's citing sources with knowledge of the talks. And it comes as President Biden once again has warned Israeli Prime Minister Benjamin Netanyahu against a ground operation in Gaza. Joining me for analysis now is our Dubai Bureau Chief, Dana Kraish. Dana, you've got this visit to Washington. What's it going to take for this to be Netanyahu's come-to-Jesus moment?
Well, at least the U.S. hopes that it is that moment. We saw kind of a little bit of a breakthrough in the strained relationship with that phone call that happened yesterday. But we also, I think it remains to be seen whether Israel, and especially Netanyahu, would listen to what the U.S. is trying to tell it. It means step back from any Rafah operation. What is also kind of new is what Biden is saying, that the Rafah operation would be a mistake, quote unquote. The U.S. has before said that if you wanted to go into Rafah, we need to see a plan that would take into consideration civilian casualties, or perhaps move people, the millions of people in Rafah, away from that area. And that is, of course, the big contention here, that where would they actually go? And like I said, it remains to be seen what they will discuss in their D.C. visit. Netanyahu agreed to send a delegation to D.C. to discuss the Rafah operation, possible humanitarian efforts there as well. So I think we'll just have to wait and see whether Israel would finally listen.
Yeah, you have to wonder what they're going to do to threaten Israel, to take away from Israel, to try and persuade them into this action. But there's also the ceasefire talks, as I mentioned. What's the latest on those developments?
Well, the Israeli delegation is in Qatar discussing a possible ceasefire agreement. We know from last week, after Hamas responded with some answers to the framework of the ceasefire, that this was actually a little bit positive, and maybe there are now serious talks on the ceasefire. So this is about what, but of course, Israel said that Hamas's demands were unreasonable, so that may be kind of a stumbling block there. But this is what the U.S. is pushing for, a 6-week ceasefire to allow for more humanitarian aid into Gaza, especially given the situation over there. We saw the UN talking about the possibility of famine in Gaza, given the very little aid coming into the Palestinian Strip. They said they wanted access to the north because people, quote unquote, are starving to death.
Yeah, so huge concerns both for the people in Rafah, but now famine potentially in the northern part of Gaza as well. Dana Kraish, our Dubai Bureau Chief, thank you for that update on the situation here in the Middle East. We are looking at futures stateside, pointing to a lower opening. Of course, we've had the Bank of Japan decision this morning, the end of an era, the end of negative rates, the yen at 149, just floating below the 150 level. and European futures pointing to a lower opening as well. Stay with us for the next hour of Bloomberg Daybreak Middle East and Africa. Jennifer Sabasaja is going to join me from Johannesburg. We'll have more on the markets and the latest geopolitics around the world. This is Bloomberg.
This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. The Bank of Japan hikes for the first time since 2007 and scraps its yield curve control. The yen weakens. Meanwhile, Australia's central bank holds the cash rate as widely expected.
Nvidia unveils a new AI processor at its company event, but the highly anticipated announcement proves to be a tough sell with investors as shares slide post-market.
And Israel and Hamas reportedly head back to the negotiating table for the first time in months as President Biden warns Benjamin Netanyahu a major Israeli ground operation in Rafah would be a mistake. It is a busy morning, but good morning to you. It's just past 9 a.m. across the Emirates, 7 a.m. here in Johannesburg. I'm Jennifer Zabasaja.
And I'm Lizzie Burden in Dubai. Good morning. Welcome to this very busy day. We have had the Bank of Japan decision, and it is the end of an era, the end to negative interest rates, the first hike in 17 years. We're going to bring you analysis of the decision and the market reaction throughout the programme, but let's get you up to speed on these markets. MSCI Asia Pacific Index is lower 0.4%, and we're looking for a lower opening both in the Europe and in the US as well after a positive end to yesterday's session stateside, driven by tech. But if we flip over to the cross-asset picture as well, you've got Treasury yields pretty steady, the two-year yield hovering near its 2024 high, 4.71%. This is off the back of the Fed cut bets being eroded further. Attention now turning to the dot plot tomorrow. Goldman economists changing their call from 4 cuts to 3 cuts this year. Oil holding at $86 a barrel, holding on to the gains. We did have that Ukrainian drone attack on Russian refineries, also OPEC supply cuts in focus. Jen, what are you watching?
That's right. I mean, Lizzie, it's really important to pay attention to what currencies are doing today. And if we look at emerging market currencies, they're still under pressure today. The MSCI basket for EMs extending declines now for a 6th day. And of course, that pressure is coming as we see the U.S. dollar strengthening as the higher for longer narrative takes hold. We're going to have to see where it heads next. But if we look at the MSCI index, it is down. If we look, zero in on the two big currencies that we're paying attention to this morning, the yen first. The yen, of course, is weakening at about 150 right now against the dollar there. You can see it. And also the Aussie dollar as well. So it will be interesting to see really how this takes shape as we pay attention to the Fed decision on Wednesday. But for more on how markets in Asia are faring, let's turn to Avril Hong, who's in our Singapore studio. Hey, Avril.
Yeah, Jen, we're taking a closer look at those Japanese markets, particularly JGB futures. You talked about the yen move. It really is about that gap. The BOJ ending YCC ETF purchases coming through with a rate hike, but it also says that it will more or less keep up the amount of JGB purchases. So futures are reacting to that. There's that buying underway, that recovery in the JGB futures. But let's flip the board and take a look at what else we're seeing in Japan. In equities, the read-through seems to be that it was a dovish hike, more or less as expected as well. So a bit of a relief on the benchmarks, the Nikkei and the Topics both running higher. Interesting to see that pullback in the Japanese financial-related stocks. These are stocks that typically would benefit in terms of profitability with rate hikes. They're underperforming, but we're seeing the real estate ones, the outperformer on the Topics today. Let's flip the board again and take a look at what we're seeing cross-asset in Australia very quickly. The RBA came through as expected, holding things unchanged. The governor says not quite sure yet whether it can rule out further rate hikes, but the reaction in the market seems to be that this was a less hawkish move. So equities, bonds picking up. We're seeing the Aussie also losing ground against the greenback, as attention, of course, will be shifting to the Fed, Lizzie.
OK, thank you, Avril Hong in Singapore. And sticking with the BOJ, as you say, a dovish hike today, the first hike since 2007, also ending its yield curve control programme. We've got our chief North Asia correspondent, Stephen Engel, live in Tokyo for us for analysis. Stephen, tell us, why did they wait 17 years and not another month for the April economic data to make this change?
Yeah, we were kind of thinking, in January when I was last here for the last BOJ meeting that they would perhaps wait till April because then they would get the quarterly economic outlook report and they would also be able to further digest those wage negotiations. But you know what? Those Shunto annual spring wage negotiations were so much stronger and they netted so much more, salary increases for corporate Japan than anticipated that perhaps Governor Ueda, whom we'll hear from later this afternoon at 3:30 local time Tokyo, essentially he had enough data to essentially move right now. So that you wanted that virtuous cycle of inflation backed by wage gains. But again, as Avril rightfully said, it was a dovish hike. Yes, they've exited negative interest rates, and it was the first hike in 17 years. But again, they also in the statement said that the BOJ will remain accommodative and essentially that the JGB bond purchases will remain at the same level, and there was no indication at all in the statement of future rate hikes. So we're not necessarily, until we get clarification from Governor Ueda, entering, so to speak, a tightening cycle. And that is why, again, the yen did weaken. It is now at 150 to the U.S. dollar. And again, those interest rate gap with the Fed possibly putting the pivot on hold, that is not going to bear well, at least in the short term, for the yen.
Stephen, what does it mean then in terms of the Japanese stock market? Because we mentioned that the BOJ is going to pause ETF purchases. I mean, what's the anticipation here?
Well, everyone I talked to this morning, we had a number of former BOJ board members on this morning, and all of them seem still fairly positive towards Japanese equities. And that is not necessarily fully priced in, according to BlackRock. His name was Yu Moma, who I spoke to earlier this morning. And he says the Japanese equities still have a ways to go. Sure, they're pulling back on the backstop, if you will, those ETFs, the backstop for Japanese equities. But again, they still see room for corporate profitability to continue. And banks will benefit, obviously, from slightly higher interest rates. And this recovery story in Japan, at least in the equity market, looks like it still has some legs to go. But yeah, they are withdrawing those ETF purchases. But a key part of that, and we'll get perhaps more clarity from Governor Ueda, is they're not going to sell down their holdings in exchange-traded funds. So they're just going to stop purchasing more down the road. And keep in mind, they only did ETF purchases 3 times last year, and they've really started scaling that back as the Japanese equity markets, obviously last year, had that incredible bull run.
Yeah, that's right. Bloomberg Stephen Engel all over the story for us in Tokyo. Stephen, thanks so much for joining us. Let's bring in our MLive strategist, Mark Cranfield, who has also been following all the news this morning. So, Mark, let's just start here and potentially with the yen, because it's really interesting what we're seeing with the yen right now. I mean, is there more room for the yen to weaken? How are you reading into this?
Yeah, it's interesting because the equity market, as you were saying, as Stephen was saying, they're pretty happy with what the Bank of Japan has done today. A dovish hike is supportive for the equity market, but of course the yen is weakening a bit. So Japan's Ministry of Finance is probably not going to be too happy about this because the problem has just been passed to them. Bank of Japan has done what it needs to do, but now the weak yen once again becomes their problem. So it's likely to drift not just against the US dollar, it also could weaken against the euro, against the pound, against some of the other major currencies. So that will push the yen down on a trade-weighted basis. Ministry of Finance won't be too happy about it. It could well go back to the weakest levels we've seen this year, and we'll be talking again about intervention risk in the Japanese currency before too long. So that's really what FX traders are watching now. We had a whole line of currency options about the 150 level, which come over the next couple of weeks. It looks as though the market is chewing through those, and that means that they're really opening up the top side here for dollar yen. So it wouldn't be surprising if before the end of the week we get some verbal intervention from the Ministry of Finance telling us that the yen has gone too far, and there will be no thanks to the Bank of Japan.
Mark, is what we've learned today actually that the Fed is the master of currencies and it's all about the dot plot tomorrow for the yen?
Certainly as far as G10 is concerned, the Fed is the big fish. They were, in terms of when they were raising interest rates, they were the ones that drove the currency markets. The dollar became strong for a long period. And now the fact that they might be hawkish for longer obviously is going to affect the currency markets again. So if they do taper the dot plots to only 2 rate cuts for this year, it will certainly have an impact. It will strengthen the US dollar, which is already doing pretty nicely anyway, and it will probably just give you a little bit more strength as well. So you're contrasting that with, we've just heard from the RBA today, they're a bit more dovish than expected. The BOJ continues to be a bit dovish. European Central Bank is still thinking about when's the right time to ease. So you put that against the Federal Reserve, who are holding rates for longer than expected. It all adds up to a stronger US dollar, and we may get confirmation of that this week with a change in the dot plots.
Yeah, the dollar currently stronger 0.2%. Bloomberg's MLive Mark Cranfield, we thank you for that analysis. Still ahead, US President Joe Biden has warned Israeli Prime Minister Benjamin Netanyahu that a major ground operation in Rafah would be a mistake. We'll bring you more on that story later in the hour.
But up next, here why Azimuth says the U.S. growth story is far more convincing than the one in Europe. This is Bloomberg.
Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Lizzie Burden in Dubai. It is the end of an era, the last central bank to have a negative interest rate regime, and the Bank of Japan has hiked rates for the first time in 17 years. Now we can bring in Nicolo Bochin, who is global head of fixed income at Azimuth, for analysis of that decision. Great to have you with me in the studio, Nicolo. It's the end of an era in central banking history, but are we right to be discussing this as a dovish hike?
Well, the comments point to dovish hike. I don't read it that dovish, simply because they stopped buying. So the end of QE in Japan is in sight. And given markets are driven by liquidity, the fact that they are stop injecting liquidity into markets and adjusting rates, and it's a minor adjustment, to me is actually positive for the yen. So I tend to be constructive here. While on rates, I expect to see a steepening of the yield curve in Japan, if not a meaningful one, but anyway, yields can move a little higher on the long end of the curve, which is something that I am not that expecting in the rest of the world.
So then, Nicolo, how are you interpreting the market moves today? Because you do say that there is some positivity for the yen in sight, but right now it's a little bit hard to see that.
Yeah, I'm the only one seeing it, basically. I want to be a contrarian here. I just look at mid-term trends. And today, if anything, is an opportunity to add yen at very attractive levels, I think. So we are not starting a hiking path here. It's just an adjustment that we have been waiting for a very long time, because we have been talking about this adjustment in rate for 1.5 years now. It happened. But more significant, as I said, is the adjustment in liquidity injections into the system.
It's really interesting. Get the yen while it's cheap, you say. Let's turn, though, to the Fed, because we've got the Fed tomorrow. Yeah. Mike Wilson at Morgan Stanley says that 4.35% is the key level on Treasury yields that could potentially disrupt the equity rally. So we're looking at Treasuries, we're looking at the dot plot. Do you agree with this level from Mike Wilson?
I don't look at levels. I look at rather at dynamics. And if anything, what the Fed will say tomorrow night will impact the short end of the yield curve, not the mid to long end of the yield curve, which has, of course, an impact on equity market. I'm still constructive on equities simply because we are in a reflationary environment. So the market are fearing the risk of reflation, and they are buying equities for that reason. And you see volatility in rates still in US because of the same reason.
Niccolo, you say the growth story in the U.S. then is still stronger than what we see in Europe. Counter what we're going to see maybe from the Fed, from what we're going to see later this week then from the BOE.
We have a decoupling in place, I think. U.S., you can have growth 2.5%. Europe is close to zero or half a point. And so it's, there is a divergence in growth dynamics that calls for different speed in the cutting cycle. So Europe can be more aggressive. US, we can definitely have only 2 rate cuts this year and happening once quarterly. So it's reflective of an environment where you have to think about positive growth in US still, while inflation is moving south, but more strongly in Europe than in US.
Only 2 cuts, another contrarian call. I wonder what data you're looking at that's giving you all of these different opinions, Niccolo, because central bankers tell us they're data dependent. I wonder if we're looking at the right numbers.
I'm looking and I'm obsessed by liquidity management by central banks. So tomorrow night, I'm not looking at the dot plot. I'm looking at decision on QT. Because the risk that we have here is that not only central banks cut rate, but they also stop withdrawing liquidity from market. That's why I have a reflationary environment as a tail risk scenario. I want to see discipline in liquidity withdrawal from markets because we still have a huge amount of liquidity which was injected after COVID. This liquidity runs the risk of being inflationary if not removed. That's why I appreciate the movement by the BOJ in terms of stopping QE. I would appreciate tomorrow night to see something smoother on the interruption of QT. So I want QT to continue if the central bank really starts cutting rates.
Nice to get your contrarian perspective. Niccolo Bokchin, Global Head of Fixed Income at Azimut, joining us in studio there in Dubai. Great to have you, Niccolo. All right, stick with us. There is plenty more still ahead. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Nvidia has unveiled new chips aimed at extending the world's third most valuable company's dominance of artificial intelligence computing. CEO Jensen Huang showed off a new processor design called Blackwell at the company's GTC conference in California.
This is Hopper. Hopper changed the world. This is Blackwell.
Let's get more from Bloomberg's Peter Elstrom in Hong Kong. All right, Peter, so Hopper changed the world. What is Blackwell going to do? Give us some of the highlights from this presentation.
Yeah, this was quite an event. It is NVIDIA's Global Developers Conference, the GTC in San Jose. It's quite an affair. It's called Woodstock for the AI geeks. And Jensen Huang began by saying, hey, this is not a concert, even though it looked very much like a concert inside of the stadium. And then he went on for 2 hours to talk about their technology, especially their ideas about AI and what they're doing exactly. So he held up the chips. You got a nice visual there where they introduced this new chip, Blackwell, that's going to replace Hopper, which has been really the driver behind the extreme rise in their valuation to more than $2 trillion right now. It's helped develop all sorts of AI technologies around the world, particularly OpenAI's ChatGPT, and set off this kind of frenzy around AI. So Nvidia is now introducing this new platform, Blackwell, that it hopes is going to take it to the next level. It's more powerful. The company said that it's 2.5 times as powerful as the chips before, and they figure that it's going to be able to open up a whole new world of development and all sorts of different industries well beyond technology itself.
Well, he looked like a Woodstock rock star in his leather jacket. Did the company live up to the high expectations?
Well, it's interesting. Expectations are very, very high. I think you're right. I think he had a new leather jacket for this presentation. Expectations were very high. The stock has gone up quite a bit. It did not look like the stock moved very much on this particular news. This news had been reported a bit ahead of time. They knew some of the details, though certainly not all the details. So from the market standpoint, it's already a $2 trillion company. It's gone up so much over the past few years. It didn't move that much now, but he did announce a number of different things, including partnerships with all of the major cloud computing companies, including Amazon, Microsoft, Oracle in particular, and then a bunch of smaller companies that are doing innovative things around these AI chips too. In particular, he talked about virtual testing in a few different categories that we haven't heard that much about in the past. One was around drug development, how you can test many drugs and medical procedures virtually instead of having to do them in the real world. He also introduced a whole fleet of robots, humanoid robots that came on stage with him, including one developed with Disney, where they feel like they'll be able to train the brains of these robots virtually and then send them out into the real world to be able to work alongside humans in all sorts of environments. So they're really announcing a vision for many years into the future that they hope they can help make become reality.
Peter, that's just frightening for me. I mean, humanoid robots. Listen, let's just talk about investors in particular. I mean, are they still bullish on Nvidia overall?
Well, yes. I mean, they're sort of crazily bullish at this point. This company has made a lot of money for investors over the past couple of years in particular. If you look at the options trading, it's really taken off at this point. There's a lot of hopes that they're going to be able to increase. There is a group of options investors who are betting that even at $2 trillion, the stock isn't near done at this point. They're expecting that it could double even just this year. So you're talking about some very extreme valuations, mostly the upside.
All right, Bloomberg's Peter Elstrom, we thank you. I hope you come back in your leather jacket the next time we have you on the programme. We've got plenty more still ahead. We're looking at futures pointing to a lower opening stateside and in Europe. So stay with us. We'll have plenty more for you. This is Bloomberg.
This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. The Bank of Japan hikes for the first time since 2007 and scraps its yield curve control. The yen weakens. Meanwhile, Australia's central bank holds the cash rate as widely expected.
Nvidia unveils a new AI processor at its company event, but the highly anticipated announcement proves to be a tough sell with investors as shares slide post-market.
And Israel and Hamas reportedly head back to the negotiating table for the first time in months as President Biden warns Benjamin Netanyahu a major Israeli ground operation in Rafah would be a mistake. It is just past 9:30 a.m. across the Emirates, 7:30 a.m. here in Johannesburg. I'm Jennifer Zapasaja.
And I'm Lizzie Burden in Dubai. Good morning. And we have had the Bank of Japan's decision. The end of an era. The last negative interest rate in the world has gone. The first hike in 17 years. A dovish hike? Maybe, but we were just speaking to Azimut's Nicolo Boccan, and he says not. Let's take a look at the market reaction. The MSCI Asia Pacific Index is lower 0.5%. Futures stateside and in Europe pointing to a lower opening later. And if we flip the board over to the cross-asset picture, you've got Treasury yields pretty steady. All eyes now on the Fed's dot plot tomorrow. The US 2-year holding at 4.72% and Brent at $86 a barrel in light of those Ukrainian drone attacks on Russian refineries, as well as the OPEC Plus supply cuts very much in focus. Jen, what are you watching?
Well, Lizzie, given this week we're focusing on central bank decisions from 6 of the 10 most traded currencies, let's take a look at what emerging market currencies are doing right now, because they're still under pressure, extending their declines for a 6th straight day. And right now the pressure is coming from the U.S. dollar as we're seeing it strengthen as that higher for longer narrative takes hold. And as you mentioned, of course, investors will be listening in intently on the Fed decision on Wednesday on how that affects some of these currencies. But let's look at two from having big headlines today, and that is the yen and the Aussie dollar, both weakening today right now. If you look at the yen at 150, and we also see declines coming from the Aussie dollar. And so it will be interesting to see how the Fed decision tomorrow potentially impacts emerging market currencies more globally. But let's pivot to markets in Asia and see how they're faring. Avril Hong is standing by in our Singapore studio. Hey, Avril.
Yeah, unpacking a bit more what we got from the Reserve Bank of Australia. The whole came as expected, but it removed in its statement that reference to the need for future rate hikes, and that's seen as less of a tightening bias, despite what the governor says about being unable to rule out future rate hikes. So that's the read-through that bond traders are piling in on, and we're seeing Aussie bonds climbing. That's really putting pressure on the Aussie in the face of what's expected to be a hawkish Federal Reserve later in the week. We're seeing it lose ground against the Kiwi dollar as well. The outlier is on the Japanese yen as the BOJ's move comes through with that dovish hike. It's really putting pressure, lots of selling on the Japanese currency. Let's flip the board because, of course, it's not just about the RBA or the BOJ. Let's take a look at how we're seeing stocks performing today. The tech sector is underperforming, and we're seeing the semiconductor-related stocks in the Asia Pacific slumping this gauge as much as 1.3%. This is on the back of the Nvidia unveiling of AI processors, which really failed to inspire Chinese developers. Also in focus, Evergrande, the defaulted developer, has been accused of falsifying revenue as much as $78 billion worth in the 2 years leading up to that default. So we're seeing the gauge of them lower today in trade. Guys.
Avril Hong, thank you for that update on Asia markets. Interesting that you note Bullock's comments there. We already had analysts warning that the RBA may not cut rates this year, but Bullock actually not ruling out more hikes. So we keep across the RBA story and the market impact. But let's come back now to this region, Africa. The worst may not yet be over for Ghana's cedi, which is, of course, Africa's third worst performing currency this year. And it's already lost more than 7% against the dollar. For more, we can bring in Bloomberg's Ondiro Oganga in Kigali. Ondiro, just explain what factors are going to drive this anticipated depreciation in the currency this year.
Lizzie, one of the factors could be weak reserves. And despite the fact that it hit a 10-month high of $5.9 billion,
all right.
Ondiro, we seem to have lost you there, but we'll get back to Ondiro Oganga if we can later in the programme. But it does look like more tough times are ahead for Ghana's cedi as the debt workout drags. I just want to take a moment to talk about cocoa while we're on the subject of Africa, because there's been this insane rally, Jen. Prices as much as doubling already this year to over $8,400 a tonne. This is one of the things that you've been looking at.
Yeah, I mean, it's a concern, I think, if we take a look at how far there is to go. And there's a lot of indications from some analysts that it could continue to rise further. And what we're seeing, the gains just in the 3 months in 2024 already exceeding the full year advance that cocoa has seen since 1976, Lizzie. And when we were just talking to Ndiro briefly about the SETI, I mean, Ghana is one of two of the biggest producers of cocoa prices. And so the question really is, how is this going to impact farmers on the ground? How is this going to impact retailers, confectioners, people who are buying chocolate? And the indication is that this could be even more upside. But how far up will it go really is the big question here.
Yeah, I was interested to see that in response, Mars, the maker of M&Ms, my favourite, and others, have been reducing the cocoa content in their chocolate. And I was going to say that this might be good for their bottom line and good for my waistline as well. But then I realised that cocoa isn't necessarily the bad bit in chocolate.
I mean, maybe it will be good for your waistline, Lizzie, down the road. But what are you going to say to a bunch of kids who are buying chocolate, right? And the real thing, you know, that we're paying close attention to, we're going to point this out later on Africa Amplified in a bit, is the mid-crop is the next focus, right? So we are about to end this critical crop season, which ends at the end of March. But then the question is, what does the mid-crop season look like? So then retailers and young kids waiting for chocolate potentially later in the year in Halloween, is there going to be less chocolate? Is it going to be more expensive? That's the big question.
It's the moment where we really need to turn into meteorologists, isn't it? Because it comes back to the weather, the bad harvest, the heavy rain, extreme dryness, crop disease. It all seems to be going wrong. And, of course, it feeds back into the food inflation picture and then into the bigger inflation central banking story as well. So we've got all of that happening in the commodities market, but we've got plenty more ahead for you on the programme as well. Stay with us. This is Bloomberg.
Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. So just before the break, we were talking about Ghana. We were also talking about cocoa prices, which Ghana, of course, is part of that. But we were speaking with our Ndiro Oganga in Kigali, who's been following what's actually happening to Ghana's SETI. So let's bring her back in. So, Ndiro, let's just talk about this. I mean, what are the factors that are driving the depreciation of this currency right now?
Jen, a couple of factors, one of them being weak reserves. And even though they hit a 10-month high of about $5.9 billion, economists say it's still very dismal compared to 2022 levels and hence cannot buffer the currency. The central bank is also saying they will not be intervening. One of the policy priorities by IMF is to build their reserves, and so they're going to allow the market forces to play out. Important to remember, there's a general election coming in December, and this will also put a lot of FX pressure on the currency. Interestingly, GCB Capital say that Ghana defaulting was a bad thing for the economy, but good for the cedi, because if they had continued to service their debt, then it would have put a lot of pressure on a currency that has lost nearly 60% of its value to the dollar.
And foreign investors, of course, will have a keen eye on that political risk. But what does the depreciation mean for the economy, Oganga? No, Ndiro, sorry.
It puts a lot of pressure on inflation. Thanks, Lizzie. It puts a lot of pressure on inflation. This is a country that inflation peaked at 54.1% in December of 2022. And then the government has been working to bring it down to a low of about 23.2% in February. Be that as it may, Ghana is a heavy importing country. And this will put a lot of pressure on the local currency because the demand on the dollar will be really high. Outside of that, we are likely to see Ghana's debt servicing costs rise for a country that is already cash-strapped.
All right, Bloomberg's Ndiro Oganga in Kigali, we thank you. You could call me Burden next time, it's OK. But let's get back to the Middle East story. Markets, we've got Egyptian stocks having slumped yesterday with the country's benchmark index erasing its gains since the devaluation of the pound earlier this month. Joining us now is our equities reporter, Farah El-Barawi. What are you hearing from investors, Farah, on this?
Good morning, Lizzie. Just looking very quickly about at the EGX 30 index, down over 6% yesterday. Yeah, absolutely. I mean, it was after it gained as much as 15% following the devaluation of the currency. But big picture, to answer your question about what investors are thinking, they're actually quite optimistic. A lot of foreign investors are thinking of coming back into the stock market, not just the fixed income space. And we're seeing a little bit of volatility, certainly. But after Egypt devalued its pound, after it had a massive interest rate hike and secured massive amounts of funding from the IMF, from the UAE, from the EU, they think that Egypt's on the right path and that the stock market could provide some opportunities, particularly that it's especially cheap compared to other emerging market peers.
Well, and Farah, if we take a look at markets more globally, let's take a step back because, of course, we're waiting for that Fed meeting tomorrow. What are strategists anticipating, the ones that you're speaking with?
Well, I'll take a look at Michael Wilson from Morgan Stanley, Jen. He is saying that the 10-year Treasury yield level that we should be watching is 4.35%. We're currently at about 4.32%. So we're nearing that level, which will be very important for stocks, as that will, he sees that linking stocks to bonds once more and increasing their sensitivity to interest rates. So really, depending on what comes out of the Fed, we might have a rally in bonds or we might have a drop, and that drop could impact stocks and could potentially disrupt the really strong rally that we've seen in U.S. stocks with the NASDAQ and the S&P 500 continuing their record rally. So again, Michael Wilson's forecast is 4,500, much lower than the index currently is at the moment.
Okay, Bloomberg's Farah El-Barawi, we thank you for that update on MENA equities. And we're going to stay in the region but head to the geopolitics, because Israel and Hamas are reportedly negotiating for the first time in months on details of a possible deal to release hostages during a temporary ceasefire. It comes as President Biden once again has warned Israeli Prime Minister Benjamin Netanyahu against a ground operation in Rafah. He says it would be a mistake. For more analysis on this, we've got Paul Wallace, our Middle East Government and Economy team leader, with us in studio. Paul, we've got the Israeli delegation heading to Washington. Is this going to be the come-to-Jesus moment that Biden had been hoping for, or what's it going to take to give Netanyahu a come-to-Jesus moment?
I think it is a big deal that this delegation from Israel is going to Washington. It's going to discuss. It's specifically there to discuss Israel's planned assault, ground assault on the Gazan city of Rafah, which I think it's fair to say the whole world does not want Israel to carry out. It's got almost no support in terms of its plan to send troops into the city. Even the US is essentially saying it doesn't want it to happen under all accounts. Until now, the US had been saying that Israel needed to move civilians out, and implying that if that happened, then it may support an offensive on the city. But it seems like that the logistics of moving more than 1 million civilians out of Rafah and then sending in troops and moving civilians out safely just isn't feasible as far as the Americans are concerned. In terms of the talks, yes, Israel sent the head of Mossad, David Barnea, to Qatar, and there is growing hope and optimism of a deal that would probably lead to a ceasefire of about 6 weeks and the release of maybe around 40 hostages held by Hamas in Gaza.
And Paul, there's also, though, growing concern about the humanitarian situation there, and especially a hunger crisis potentially happening in the region. I mean, what can you tell us about that? What's actually being done, considering these ceasefire talks are where they're at right now?
I think the hunger situation, the dire humanitarian situation in the Gaza Strip, is behind a lot of the US's urgency to get a ceasefire and to get Israel to hold off on an attack on Rafah, which, by the way, Prime Minister Benjamin Netanyahu says will definitely happen. His public stance is that the assault on Rafah is just a question of when, not if. But you saw the IPC, which is sort of the global body that determines whether or not a famine is happening somewhere in the world. They put out a very grim report report yesterday, and they said that famine is looming in the north of the Gaza Strip, and that the situation regarding food is getting worse in the south, in and around Rafah and other parts of the Gaza Strip. The US, the likes of Jordan, the United Arab Emirates and Egypt are really pushing to get more aid into the Palestinian territory. Of course, they've been using trucks to deliver food and medicines by land for months now. More recently, they've taken to airdrops, and in the last week, they've opened a maritime corridor from Cyprus to Gaza to get more aid into the Strip that way, and especially to the north of the territory, which is facing the worst food and hunger problems. I think Israel is beginning and has started to make more concessions on this, and Benjamin Netanyahu, in recent interviews with US media, has admitted that Israel has a responsibility to try and get more humanitarian supplies into the territory. Israel is still saying it's not its fault. It's saying that the UN is facing a lot of problems once the aid actually gets into Gazan territory, but nonetheless, Israel is saying that it will push even harder from its side to ensure there's more aid into Gaza.
Paul, appreciate your insight into the latest in the situation there. We'll see how the delegation in Washington pans out. Paul Wallace, our Middle East government and economy team leader there in Dubai for us. All right, let's pivot to Barclays. Barclays says it's seeking to expand relationships with sovereign wealth funds and private equity giants as it seeks greater profitability from advisory and equity underwriting. CEO CS Venkat spoke to us exclusively about the business outlook ahead of key central bank decisions this week.
Lending is an important part of what we do. We are a very big player in the fixed income markets, in the debt capital markets, as well as fixed income trading. So lending is a part of what we do, but we're just trying to broaden it into more advisory and more equity-related revenues.
How much is this sort of a new model of banking that's basically taking all of Wall Street and a lot of the global banks too, which is trying to cater to the whole client rather than, say, go after specific deals and be focused on, for example, being at the top of a league table?
Yeah. I think it's an important part of the shift that's happening. And it's happening because previously, in the investment banking side, we were working with corporations. And since then, we still work with corporations in a very big way. But in addition to that, you've got the financial sponsors and the sovereign wealth funds. So the growth of concentrated pools of capital makes it important to have that full relationship with those players in the market.
This week, we do get a Bank of England decision. Is it beneficial if rates stay higher for longer, or do you want them to come down to support the economic growth and maybe some of the engine that John was talking about?
So ultimately, that's a decision they have to make. It's very important to balance.
Sure. But,
yeah.
You know.
I actually think a little prudence and waiting a little is not a bad thing.
You think there is an option there to wait a little longer then? Why do you think so? Why is the bigger risk maybe to cut too soon and not to hold too long?
Well, I think that the economy is stabilizing. Employment is still robust. Inflation is coming down. So I think on the balance, it might be more prudent to wait a little longer. Now, our house view and that of many others is for more rate cuts over this year.
Would the same apply to the US? The same characterization of the situation?
I think so, yeah.
Well, but just, would that be good for you? Are high rates good for banks, or are they bad for banks? This has been a perennial question.
Stable rates are good for banks.
A reluctant CS Venkat there to tell the BOE what to do, except perhaps exercise a little caution when it comes to cutting. But he was speaking there exclusively to us on Bloomberg Surveillance. We've got plenty more ahead still for you. Stay with us. This is Bloomberg.
Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Jennifer Zambasaja in Johannesburg. UBS Group shares hit a 16-year high this month, capping off a remarkable run in the year since it took over its beleaguered rival Credit Suisse. Following a series of restructuring moves, CEO Sergio Armati now aims to crack the lucrative U.S. wealth management market. Bloomberg's Samuel Etienne reports.
Who would have expected UBS shares to have soared since the bank took over its ailing Swiss rival Credit Suisse 1 year ago? Yet that's exactly what's happened, with the stock hitting a 16-year high in early March. Behind this, confidence in Chief Executive Sergio Ermotti's turnaround of the Swiss lender and integration of the two banks.
I think it's very important for investors to understand how we are connecting the dots between what we said in summer last year and in respect of our long-term plans.
Ermotti's goal is simple: to make UBS the undisputed global wealth champion and take on Wall Street rivals where they have the home advantage. In the US, UBS chief hopes to leverage former Credit Suisse clients in the US and manage their wealth, including those still building their fortunes. But catching up with these American financial giants will take time and come at a cost.
More than 50% of our cost is headcount, and there are duplications, but we try to do it over time.
European banks, including Deutsche Bank and HSBC, and even UBS, have previously tried to crack the US market and had to pull back. But this time, UBS aims to be the one left standing at the end of this round.
Great package there from our Samuel Etienne. Now, I just want to bring you some breaking news. We have the US Secretary of State Antony Blinken speaking in Manila. He says he has concern about China's actions in the South China Sea. He says China has repeatedly violated the Philippines' rights. So he is speaking there, and he's a busy man, Mr. Blinken. He's been travelling in Europe and Asia since Thursday. The US State Department saying that he's actually coming our way. He's extending this current trip. He's going to be making stops in Saudi Arabia and Egypt with leaders and other officials from other countries in order to get back to what we were just talking about, the situation in Gaza, a desperately bleak situation for people on the ground, the tensions persisting between Washington and Israel. Tom McKenzie will have plenty more on all of that for you on Daybreak Europe next. This is Bloomberg.